Why do people choose this and why it's so popular? Starting with kind of this most powerful benefit.
Yeah, so probably the biggest benefit over the long term is that because the grantor trust is disregarded for income tax purposes, and the grantor is actually on the hook for its income taxes, that the grantor can pay the trust income taxes without that being considered a gift for gift tax purposes. So let's say you make a $5 million gift through an IDGT, and so the trust has $5 million of assets. It's generating $400,000 a year of income, which is, $200,000 a year of income tax liability. Rather than having the trust pay $200,000 of income tax, which would burn some of the value inside of the trust, you can actually pay the trust taxes for it. Since you're technically the taxpayer for income tax purposes, that's not a gift. You're just paying your taxes that you owe, but you're essentially transferring $200,000 to the trust because that's $200,000 of tax that the trust isn't paying. So you're getting $200,000 out of your estate and into the trust, which is outside of your estate. So that's a huge gift, and that's just year one. Over time, because the trust isn't paying its own taxes, you are, the trust is going to be able to compound at essentially pre-tax rates of return. And so let's say you have an investment that's generating a 10% pre-tax return, 7% post-tax. The trust is actually going to be generating 10%, both pre and post-tax, since it's not paying its taxes, you're paying them. And because of the magic of compounding, over an extended period of time, the trust is going to grow much faster than your personal assets, which means that in 20 years, A, the trust is going to be enormous probably, and B, your annual income tax payments are going to become quite substantial. Let's say somebody had $10 million and they just put $1 million into an IDGT. The income tax liability in year one might not be that much, but by year 20, with the trust growing faster than the grantor's personal assets, is probably going to be a very large fraction, maybe a majority of the grantor's assets. And at that point, those annual sort of tax gifts are going to be quite significant.
Yeah, and just to add some numbers to this is to make numbers simple. Let's say your assets are growing at 10% a year. One, hopefully everyone here understands the value of compounding. If your assets are growing at 10% a year, they'll roughly double every 7 years. So let's say you have $10 million in this trust and it's growing 10% a year. So it's growing $1 million. And let's say you generate a full tax liability. You sell all of that and it's long-term capital gains. So it's a $350,000 tax liability for that 1 year. Now, let's say you're out of your lifetime gift exemption. You paying that tax, one means personally paying the tax on the trust income means the trust doesn't have to lose $350,000. So it can invest that $350,000. Now, that means one, it's growing at its pure growth, right? It's not losing taxes and it's getting the compound growth on what would have been lost tax money. But then it also means that your estate, not only are you paying the taxes on your own income and your own realized capital gains, but you're slowing the growth of it because you're paying someone else's, in this case, the trust taxes. And this is why the IDGT really makes sense for individuals who are fairly well over the estate tax exemption, is because if you don't lower the size of your estate and you've used up your lifetime gift exemption, you're going to lose at least 40% of that delta over the lifetime gift exemption to estate taxes. So part of your goal is get assets out of your estate, have those grow as quickly as possible, but it's also ensure that your personal estate doesn't keep growing faster because you're going to lose at least 40% of that growth. And so this is where the power of have those assets grow faster outside of your estate, essentially tax exempt, and then you slow the growth of your own estate so you're sure that when you pass away, that it's not mostly lost to estate taxes. And this is probably the most powerful benefit of IDGTs. And this in combination with kind of one of the next things we talked about, we've worked out the math and we have calculators and things like that we can illustrate this with, is someone who has $1 billion and hasn't done estate planning, in a decade, they can really move all of those assets outside of their estate with the proper kind of market environment so they can completely avoid estate taxes in a decade. And it's hard to really understand this, but these indirect gifts and paying off the taxes is an incredibly powerful estate tax mitigation tool.
Yeah. So then there's this tax-free transactions bucket, which Buck Money referred to a little bit. So that's a grab bag of things. This is all stuff that you can do with the trust that doesn't generate income tax liability because it's a disregarded taxpayer for income tax purposes. So there's a bunch of stuff. So one thing you can do is you can swap assets with the trust. So let's say that the trust has a $2 million asset that you would like to get back into your own name for whatever reason. There's a bunch of reasons why that might make sense. And you had $2 million of cash in your own name. You could swap the appreciated asset inside of the trust, get that back from the trust, give the trust $2 million of something else like cash or whatever. And then that's not treated like any sort of realization event. So you wouldn't have recognized any gain. There's no income tax consequences from swapping assets out of the trust. Also, no gift tax consequences, assuming that you transfer an asset that has an equal value to the thing that you're transferring out. So really flexible structure. Another thing that you can do is you can loan money to a trust or borrow money from the trust. So let's say you have some kind of liquidity need and the trust has $1 million of cash. You can borrow that $1 million of cash at the applicable federal rate, which right now is around 3 or 4%. And you can pay back the trust at some future date when you have liquidity to pay back. And then you can also loan the trust money. Why would you loan money to a trust? Essentially because the interest rates, the applicable federal rates, are generally lower than most investment returns. And so you can capitalize on the spread between the government interest rate and the investment return. So let's say you have an investment that you think is going to generate 10% annual returns. If you can loan the trust money and the trust only has to pay, let's say 3% interest each year, then it'll basically be able to capture the 7% spread between the 3% interest rate and the 10% returns. It'll be able to capture that spread. And so at the end of the whatever 9-year loan, whatever it is, you'll have transferred a ton of value to the trust just by letting it keep that investment return.
Yeah, and just to really hit this home, so and this is what conjunction was saying is this is how someone is worth $1 billion inside their estate and can in a decade get all of that, essentially those assets outside. So one is you transfer these assets to the trust. As the assets in the IDGT grow, you pay the taxes on. So one, you have an additional cost on your side and the trust grows tax-free. And then you can cap this on top of it of swapping, or if you loan money to the trust, what that means is, and another side of this is, you're able to effectively capture this arbitrage. Now, again, generally, folks who are facing estate taxes are on average better at investing and growing their assets. And so if you're able to say, hey, my personal estate, I'm capping it at 4% growth. So that means your estate is only going to grow at the top line 4%. But then you loan it to your trust, let's say invested in, let's say stock market's growing 9%. Private equity is growing 14%. Let's say you invested in alternatives and you're growing at 14% a year. So now there's this 10% arbitrage that the trust is growing on loaned money. And then on top of that, because this is an intentionally defective trust, you are personally paying the taxes on the income that the trust is generating on your loan. So there's this kind of combination where you cap your personal growth, then the trust is able to hopefully arbitrage it and invest those assets and grow faster than this interest rate of, let's say, 4%. But then because you pay taxes on that 4% that you're earning from the trust is really significantly less than that between taxes. And this is as the trust grows faster and has more assets, you're actually typically reducing the size of your estate. It's such a powerful tool. We can't say that enough of the tax benefits of IDGTs when you're over the lifetime gift and estate tax exemption, and you want to minimize those taxes. But maybe let's jump to what are some of the non-tax benefits and trade-offs here.
Yeah. So the big non-tax benefits are, so asset protection. This is true of other trusts too, but assets inside of an IDGT are not reachable by your creditors generally or by your beneficiaries' creditors. That's also true of non-grantor trusts, but it's a big benefit of setting up trust in general. You retain indirect access. So with an IDGT, you can borrow from the trust. So let's say you need liquidity for whatever reason. you need $1 million of cash. If the trust has $1 million of cash, it can loan you the money. That interest won't be taxable, and then you can pay it back when you have more liquidity. And so that's a nice feature for people. And then indirect control is referring to if you give someone assets outright, as soon as you transfer the asset, you're basically surrendering all control over the assets. If you set up a trust, whether an IDGT or some other type of trust, you retain some amount of control over those assets. You could have rules in the trust about distributions. You could name your friend as trustee to make distribution decisions. And so you're retaining some form of control, even though you're probably not going to be the trustee yourself. You're retaining some sort of control over the trust that you wouldn't have if you just made an outright gift.
Yeah, and this is, by the way, there's obviously asset protection, this indirect control. I do think that one of these things is people are always worried about this goes to the trade-offs. This is an irrevocable trust, you're giving away assets. People often worry about how do I make sure I have enough for my spouse's kind of welfare and livelihood and not being able to take again. These loans are at typically commercial terms. They're at it's what's called the IRS's like interest rates, which tend to be lower. You're able to have people tend to find that as a comforting feature that they can have this indirect access and provide liquidity in the event they do need it.
Yeah, so the IRS interest rates, which are called applicable federal rates, are tied to treasury yields. So there's 3 different interest rates without going too deep into it. It's basically, depending on the term, it's either the 1 to 2 year yield, the 7-year yield, or the 20-year yield. So right now, the 1 to 2 year is like 4.5% or something. The 7-year is about 3.6. It's going to be 3.6. And
yeah, it's because the short moral of the story is just, first of all, we're pretty high interest rates.
Something. Yeah.
Yeah, it's typically when I was using 4% as a loan rate, that's probably pretty high. Historically, it's in the 3% range.
And as the Federal Reserve cuts interest rates, it'll settle around 3%.
Yeah. Let's jump into what are the downsides or trade-offs with this structure?
One is what you mentioned, these trusts are irrevocable. You can borrow some of the money back as a loan, but you can't just take back the money and say never mind in a year for 2 years from now. So you are making a gift to a trust, even if it's a flexible trust.
By the way, that being said, you don't have to gift all your assets at once. And the most common approach is people will start gifting some portion of their assets or a particular type of asset, and they'll gift more over time. So it is a date, all or nothing. It tends to be an incremental, gradual process.
Yeah. And then we mentioned other types of trusts, like non-grantor trusts that have state income tax savings. They're really a gift and estate tax saving vehicle, very efficient from a gift and estate tax perspective, not really saving state or federal income tax overall. If you really wanted to save New York income tax, a non-grantor trust might make sense because you could set up a non-grantor trust in South Dakota or something like that. And it's just not going to save you New York income tax. If you're a New York taxpayer, the trust is also a New York taxpayer.